The Honest Money podcast is brought to you by Prescient Investment Management. We consider everything to give you the advantage. It's the future of investing. Prescient Investment Management is an authorized FSP.
Welcome to Honest Money. I'm Warren and he's
Pieter Villiers from Money Marks.
We're answering one of your questions today, and it's from Gert. And I must say, I like Gert's question. Firstly, there are not a lot of people that will be in a position where they're earning such a big taxable salary that they can get to a limit on how much they contribute to retirement funds and then consider other options. But there are still, there's still a lot of people in South Africa that earn well, and not all of them are in government. Let's not be cynical now. So I thought maybe before we get into the real answer, was maybe just to explain that the contribution to a retirement fund, how you get to that limit, because I think that's an important thing, and there's a tax implication there that you know better than me.
Yes, so just a general rule around retirement funds being regulated by the Pension Funds Act is you can contribute up to 27.5% of your taxable income. Now, taxable income basically means your salary, a bonus, rental income, commission, side hustle,
interest,
everything that you earn, 27.5% of that, or 350,000 rand. So the lesser of either of those. So if you earn 2-3 million a year, you're probably going to be at that 350,000 rand mark, where that is your limit. But if you earn 100,000 rand a year, you can only contribute up to 27,500 rand, because that's then the lesser amount. So that's what we say what you're allowed to. It means that you can over contribute more than that amount, but then you only be able to benefit from the tax deduction up to that percentage. So if you over contribute to that just gets rolled over to the next year, and then you can get the tax deduction there. There is one thing that's a little bit more technical, but if you over contribute towards a retirement fund, that over contribution amount, where the general rule around retirement funds is they fall outside of your estate. So estate duty, which is a type of death taxes that you'll pay when you die, will not be applicable to retirement fund investments, but any over contributions could be. So just something to take note of. Again, this is more of a technical thing. We're not going to go too deep into that. But that's a general rule around how much you can contribute. Gert mentioned a provident fund, so that's a type of pension fund that you get through the work, but it's the similar thing to like a retirement annuity. A tax-free savings account, on the other hand, that you also referred to, your annual yearly contribution is limited to 36,000 rand. Now be careful here, because if you over contribute to that, it doesn't roll over and you get the benefit the next year. SARS claps you with a 40% tax penalty. So that's very important to understand the difference. You can over contribute towards a retirement fund, which includes a pension fund, provident fund, retirement annuity. It's rolled over to the next year and you can get the benefit. Tax-free is not the same, so please never over contribute to that. So that's kind of the rules around it. And now his question is, if I now have reached that limit, so the 350,000 rand into a provident fund, I've got extra cash. Do I put that into the provident fund as an over contribution, or do I put it into tax-free savings account, or do I invest it in something else? And that's kind of what we'll talk about today.
Yeah, and maybe as a principle, I think maximizing the tax benefit that you get from a retirement fund on that tax deduction. So, getting to the 350,000 rand limit, if you earn that much money that you can do that, I think it's a good decision. You should do that. I'm sure there are tax boffins, and they're probably all very exciting accountants that will say, no, but there's still a benefit to doing more than that 350. I'm sure that they'll show me on a calculation that they are right. Preference, though, for me, my own preference, if I'm investing my money, I'm going to do the 350,000 as a limit. And the reason is a couple of things. One, it requires you, if you're a taxpayer and you've over-contributed, you're going to have to keep really good records of what you've done and how you've contributed. You're going to probably need to keep a proper proof of documents as proof. It's not just what you're saying. And if there is a benefit to be gained in 10 or 15 years' time or something, you're going to have to fight with SARS, is my sense of this. And I don't want to fight with SARS ever, and certainly not about historical things that happened a long time ago. So I'm going to kind of stick to the generic, simple rules on the basis that I don't believe SARS always has the ability to deal with this kind of complexity into the future. And so keep it simple, stick to what the rules that everyone else is kind of mostly sticking to. In this instance, I think is a very good call. And then rather do other stuff with your money. I'm not saying go and spend the money, because that's really a bad idea. Gert, we like your question. We want to help you. I just feel maximize the retirement fund contribution. No brainer. I think we'll agree that you should maximize your tax-free. And that doesn't mean that's the end. I mean, then you should carry on doing other stuff.
Yeah. And also, just to kind of play it into the future, Gert mentioned now 15 years is kind of the time horizon that we're looking at. So let's assume Gert is 50 years old, he's retiring at 65, and now it's that period of preparing for that date of retirement. And now we've spent a career to build up money, and the retirement just essentially means we don't have to work anymore, and we can now draw an income from what we've built up. So the way that the tax-free savings account and a retirement fund or provident fund will be taxed at retirement, I think is also important just to take into account, because a retirement fund is not necessarily tax-free in the sense that there's no taxes. It's tax deferred. So you put money in now, you get a tax deduction, your money grows tax-free. But when you retire, you pay taxes. So if you take out a cash amount, there's a table that they apply. You draw a monthly income, it's added to your income. So you pay taxes later in your life. But the idea is, if you're working and you're contributing to a retirement fund, you're probably going to be in a higher tax bracket. So you benefit from the deduction. When you retire, you're probably going to be in a lower tax bracket. So you kind of benefit from that differential. Whereas a tax-free savings account, you put in your after-tax money. So you don't get a tax refund with the contributions to a tax-free savings account, but it goes tax-free, and you can take it out at any point in time, also tax-free. So there's that differential in terms of deciding which one is which. But I think what we also need to talk about is let's say in this scenario he's 15 years away from retirement. What I've also sometimes seen is people tend to have like paying off their home loan, so they've got a paid off house, they've got a lot of money in retirement funds, which is a good thing, but they then it becomes a bit tricky because you now need to draw an income from that. And sometimes that is fine to pay for your day-to-day stuff. But what about that holiday, that overseas holiday that you want to go? There's some rules around how much you can generate from a retirement fund and how often that can be revised. And then there's the liquidity side of what is also important in retirement. You can maybe talk a bit around that.
Yeah, I think, if you look at your retirement funds as the source of your day-to-day expenses at retirement. So when you stop work one day, replacing your salary with a monthly pension, for want of a better word, makes sense. But as you say, you're going to need accessible capital, and it might be chunky amounts of money, because somewhere along the line you're going to need to fix your roof. Somewhere along the line you're going to need to buy a car, and you shouldn't be financing cars if you're retired. And equally that holidays and maybe a chunky medical expense that wasn't covered by medical aid. So having accessible money that you need to be able to get hold of at a reasonably short notice will be important. And so, I mean, the jargon for that is discretionary money. So if you've got retirement money, the stuff that's not retirement money is called discretionary. And for people that are in that wealth space, so people that are contributing $350,000 a year to their retirement funds, and they've got extra money to save, when they get to retirement, for me, my rule of thumb will try and be to have about 50% in retirement funds, 50% in not retirement funds, if you can get there. Because then also you've got a lot of flexibility to say, well, I'm going to draw some of my income from retirement funds. As you said, the income that you take from your retirement funds, you're paying PAYE. So you don't really want to get to the very high tax brackets if possible. But that might also mean that you can draw a little bit of income from your discretionary money, from your not retirement funds, because then you're going to pay capital gains tax. Blending those two together becomes very nice. And what do you do with that not retirement fund money or discretionary money? Yes, tax-free savings will be a portion, but that might be quite small in your life. Valuable, so please don't ignore it, do it, but also that you might invest in exchange-traded funds or unit trusts, or, and this is my quick curveball, for the very wealthy people who are always going to be at the very high income tax bracket because they have a lot of assets, actually the kind of one thing, the one nugget of information they might take out of today's endowments are their friends. Because an endowment, if you put the money in and it's a very low cost endowment offered by an investment platform, you're probably going to end up paying 0.2 or 0.3% a year for administration. But the endowment pays tax at a rate of 30% on income and 12% on capital gains tax. So there you go. I do have some tax knowledge. And there, I think for someone who's always going to pay 45% tax on income, putting money into an endowment now, if you've got a 15-year time frame, and allowing it to grow means that at retirement, you could start to say, well, I'm going to draw income out of that. Once it's gone through the 5-year period, you're now able to draw an income that's tax-free for you because the endowment's paid it already. So that's the tweak. That's the inside nugget in the wealth management space that a lot of people won't really think about. But, Pieter, if you're sitting in a situation where you're going to pay income tax at a rate of 25% all your life, an endowment's not the thing for you because you're not going to get a tax benefit. Your money's maybe costing you a bit more than everyone else from an investment perspective because you've got administration fees and there's some rules that you need to live with that 5-year period. So understand that it's applicable nowadays. In the old days, when I was young, endowments were great for younger people with smaller amounts of income, and that whole thing has shifted now. Endowments are not great for younger people; actually, great for people that pay a lot of tax.
Yeah, and I'd assume again, if Gert can contribute up to 350,000 Rand into a provident fund, the high income earner, he understands and he feels the burn of taxes in his pocket. When salary comes in, there's taxes. If you invest, there's taxes. So you need to tax planning becomes very important in this scenario. So maximizing the tax benefits. So we've maxed out an RA or a provident fund in this case, maxed out a tax-free savings account after that. Then yes, definitely I like the endowment idea because that is not tax-free, but it's tax-limited, I guess, is the kind of phrase that we can use. And what I also like about an endowment is whether you get a local one in rands, but you also get an offshore one in dollars, which is quite important because it's a one little hack that you can apply to when you should you pass away, you can nominate someone else. Getting a bit more technical here, as a life assured, which means the endowment can continue living on. Let's say you've opened one overseas in dollars and you nominate your spouse as the life assured. If you pass away, that investment can still live on. It doesn't have to come back to South Africa. You're going to have to pay a state duty on it, but that's fine. But it doesn't have to convert back. So you can actually build an international portfolio for your family by using such a type of structure. If you're in that space, the minimum requirements for those types of offshore endowments are quite hefty. It's about 400,000, 500,000 Rand. But in this case, it's probably something that could be considered, again, also from a form of diversification. Having everything, most of your wealth tied in retirement funds in rands, that is a bit of concentration risk that we could diversify. So these are some ideas that we can think about. But also there's merit to having liquidity and options available in retirement that you can take out lump sums. So when you get to retirement, provident fund or a pension fund or RA has to be converted to either something called a living annuity or a life annuity. Living annuity is like an investment, but you're limited to 2.5 to 17.5% drawdown, and that can only be revised per year. So if you know that this is my monthly expenses and this is my drawdown, but something comes up and you just have that, then you're going to probably run into trouble. So it's nice to have that liquidity side that you can take out that lump sum. So building onto that is important. Although that might not be tax-free or tax-deferred or tax-limited, at least it gives you that buffer to be able to access.
Yeah. And maybe just, for Gert and other people in that sort of position, focusing on being tax efficient it's an important criteria. It's not the most important.
Yeah.
I feel at retirement, flexibility is much more valuable than being ultimately tax efficient to the last cent. Again, that's going to freak the accountants out. That's fine. I don't mind freaking the accountants out. Because life doesn't happen in a spreadsheet. Life happens out here, in the big scary world. And being able to draw on a large amount of money in an emergency or to make a big lifestyle decision is really important. And lots of practical things happen. So, for example, if you're leading up to retirement, you might be living in your family home that's been paid off for a decade. and now you decide I'm relocating to the coast because all my family live there, and you have no accessible because everything's in a what a disaster. So now you've got to sell your house. That's stressful. Got to get that money, then go and live somewhere for a while until you find a house to buy. If you've got accessible capital, you might have the ability, if you've got the sufficient money, to say, okay, I am going to sell my house, but I'm going to buy the other house first because I've got the capital to do that. Then I'm going to sell my house. The stress is less, et cetera, et cetera. Is that a recommendation? No, it's just saying you've got the flexibility to do those things. So you want to give yourself choice and flexibility for people who have capital and have the time. I think it's much more valuable than saying, I've saved myself 0.23% on estate duty when I'm dead. You know what? You don't care. You're dead. It's gone. It's over. Don't worry about it. Flexibility while you're alive is much more.
Yeah. And it gives you the options, because in retirement, your life will change a lot to what you used to. And visiting kids becomes probably quite important, and grandkids, and liquidity. I'd agree with you. It would be quite a sad situation if you actually have the capital available to go visit your kids and grandkids overseas, but it's tied into some structured rule that you can't access that when you need it now, and that would suck. So it helps to bring those options in retirement where it's most important. And I agree, tax planning is important, but it's not the most important. Most important is probably asset allocation. Well, get technical, how we invest first. That's going to show the returns that we get, but it forms an important part. You should just be careful not to become too fixated on just the taxes side of things.
Yeah.
I think that especially once you start paying so much taxes, that is easily something that you can get stuck in. Being honed on just how can we save taxes as much as possible, without considering other important areas as well.
Yeah, and I think you're right. I mean, rather be in a position late in life where you're paying tax on growth, on assets, and you can complain about that every time you're doing a transfer to SARS, but you've got a lot of choice and a lot of capital available because you made sensible investment decisions, not tax decisions, early in life. I think it's a good place to wrap up. Gert, we love the question. Thank you so much, and to everyone else listening as well. I mean, please keep them coming. We love your questions.
Yeah, it's great, and I think this is also nice to speak at different levels. So the previous episode we spoke about a 24-year-old and what they need to consider, and this is more closer to retirement. So we like to have a diverse type of questions that come through, because then we can also speak at different levels, because we're all at different stages in our lives and there's different things to consider. So if you are closer to retirement or in retirement and you have some questions, please send them through. We'll be happy to answer as best as we can. And thank you so much for watching, and see you in the next one.
Yeah, thank you. Don't forget to subscribe, and we'll keep sending you the content.
The Honest Money podcast is brought to you by Prescient Investment Management. We consider everything to give you the advantage. It's the future of investing. Prescient Investment Management is an authorized FSP.